In the labyrinthine world of global finance, two names consistently emerge as omnipresent forces: BlackRock and Vanguard. They are not household brands in the consumer sense, yet their reach extends into nearly every aspect of our economic lives. This investigation probes beyond their public perception, examining how these asset management behemoths wield a quiet, yet profound, influence over the world's largest corporations and, by extension, global geopolitics. Our focus today is not just on their size, but on the intricate web of control they've woven, particularly over brands we perceive as fierce competitors. To grasp their influence, one must first comprehend their sheer scale. As of late 2023, BlackRock reported approximately $10.5 trillion in assets under management. Vanguard, a close second, manages around $8.1 trillion. Combined, these two firms oversee nearly $19 trillion. To put that in perspective, this figure exceeds the gross domestic product of every country except the United States and China. This unprecedented concentration of capital grants them an extraordinary position at the apex of the global financial system, allowing them to shape market trends and corporate strategies on a truly global scale. Their growth is largely fueled by the passive investing revolution. Unlike actively managed funds that pick individual stocks, passive funds, primarily index funds and ETFs, simply track market indices like the S&P 500. This strategy means they automatically become major shareholders in every company within those indices. BlackRock's iShares and Vanguard's index funds are among the most popular. This approach, while often praised for its low fees and broad diversification for investors, inadvertently funnels enormous voting power and ownership into the hands of a very few asset managers. Consider the fierce rivalry between tech titans Apple and Microsoft. These companies spend billions competing for market share, talent, and consumer loyalty. Yet, market data reveals a surprising commonality. According to institutional investor filings, BlackRock is a top shareholder in both Apple, holding an estimated 6.8% of its shares, and Microsoft, with approximately 7.2%. Vanguard mirrors this, owning around 7.5% of Apple and 8.1% of Microsoft. This means the two largest institutional shareholders are often the same entities, quietly sitting atop the ownership structures of these supposed arch-rivals. This pattern extends across numerous industries. The cola wars between PepsiCo and Coca-Cola have been a marketing battleground for decades, a quintessential example of capitalist competition. However, a closer look at their ownership structures reveals a similar dynamic. Public filings indicate that BlackRock holds approximately 7.1% of PepsiCo and 7.8% of Coca-Cola shares. Vanguard's stake is equally substantial, with roughly 8% in PepsiCo and 8.5% in Coca-Cola. The implication is significant. The same two major asset managers are among the largest owners of companies that dedicate immense resources to outmaneuver each other in the marketplace. This raises questions about the very nature of competition. When the same few entities are major shareholders in competing companies, economists and antitrust experts raise concerns. This phenomenon is known as common ownership. Research by Professor Jan Fichtner and others suggests that common ownership by large institutional investors can potentially dampen competition, as it may reduce the incentive for companies to aggressively compete on price or innovation. While BlackRock and Vanguard maintain their role is purely fiduciary to their fund holders, the sheer scale of their cross-holdings could, some argue, lead to a quieter form of competition, even without explicit collusion. Beyond just ownership stakes, BlackRock and Vanguard exert significant influence through their voting power in corporate governance. As major shareholders, their votes on board appointments, executive compensation, and strategic initiatives carry immense weight. Collectively, these two firms can represent 15 to 20% or more of the votes cast in many large corporations. This substantial block of votes allows them to shape company policies and even influence the composition of corporate boards, often favoring candidates aligned with their broader investment philosophies, which include a growing emphasis on environmental, social, and governance, or ESG, factors. The rise of environmental, social, and governance criteria in investing has been significantly championed by BlackRock and Vanguard. BlackRock, for instance, reported over $2.7 trillion in assets under management across its various ESG-focused funds as of early 2023. While proponents argue ESG is vital for long-term sustainability and risk management, critics suggest it grants these asset managers undue power to dictate corporate agendas that may not always align with maximizing immediate shareholder returns. Their calls for companies to reduce carbon emissions, improve diversity, or enhance labor practices can reshape entire industries. The influence of BlackRock extends far beyond corporate boardrooms. The firm has increasingly positioned itself as a key advisor to governments and central banks around the world. Historically, BlackRock has provided advisory services to the U.S. Federal Reserve, the European Central Bank, and even countries like Greece during its debt crisis. More recently, BlackRock has been reported to be advising the Ukrainian government on establishing a reconstruction bank. This role places them at the heart of global economic policy decisions, giving them a unique vantage point and potentially significant sway over national financial futures. Another facet of their geopolitical influence comes from the revolving door phenomenon. Numerous high-ranking officials transition between government positions and senior roles at BlackRock and Vanguard, and vice versa. For instance, former U.S. Treasury Secretary Larry Summers served as an advisor to BlackRock. Philip Hildebrand, former chairman of the Swiss National Bank, is a vice chairman at BlackRock. This continuous exchange of personnel between the public and private sectors creates a powerful network, granting these firms unparalleled access and insight into global regulatory and political landscapes, potentially blurring the lines between corporate interest and public policy. The energy sector, a cornerstone of global stability and geopolitics, also falls under the significant influence of these asset managers. Both BlackRock and Vanguard are major shareholders in the world's largest oil and gas companies, such as ExxonMobil, Chevron, and Shell. Simultaneously, they are significant investors in renewable energy companies and actively advocate for climate-related initiatives through their ESG mandates. This dual role creates a complex dynamic. They profit from traditional energy while simultaneously pushing for a transition to green energy, holding sway over both sides of a critical global transformation. In the realm of national security and international conflict, BlackRock and Vanguard are key investors in major defense contractors. Companies like Lockheed Martin, Raytheon Technologies, and Northrop Grumman, which manufacture everything from fighter jets to missile defense systems, count these asset managers among their top shareholders. This positions BlackRock and Vanguard as significant stakeholders in the global defense industry. Their financial stake ties them directly to the outcomes of geopolitical tensions, and their voting power can influence the strategic direction of companies critical to national and international security. This is a point rarely discussed publicly. The aggregated effect of these myriad holdings is a vast, interconnected network of control. While each individual stake might seem passive, the collective power of BlackRock and Vanguard means they are often the largest or among the largest shareholders in hundreds of companies across virtually every sector, from technology and consumer goods to energy, healthcare, and finance. This creates a unique form of systemic influence, where two entities possess a significant say in the strategic decisions of a substantial portion of the global economy, all while presenting themselves as neutral custodians of capital. Despite their immense size and influence, BlackRock and Vanguard often operate under a different regulatory lens than traditional banks or even hedge funds. Their passive investment model, which emphasizes tracking indices rather than active trading, has often been viewed as less risky or systemically important by regulators. However, critics argue that this overlooks the concentration of voting power and the potential for a few firms to influence corporate governance across entire markets. There's an ongoing debate whether existing regulatory frameworks are adequate to address the unique challenges posed by these new financial leviathans. Both BlackRock and Vanguard consistently emphasize their role as fiduciaries, managing money on behalf of millions of individual and institutional investors. They assert that their voting decisions are guided by maximizing long-term shareholder value and promoting sound corporate governance, not by pursuing their own agendas. However, the sheer breadth of their ownership and the depth of their connections raise complex questions about true neutrality. When you own stakes in every major player, and advise governments, the lines between a neutral investor and influential actor become increasingly blurred, inviting further scrutiny. In conclusion, BlackRock and Vanguard represent a new frontier of financial power. Their immense asset bases, driven by passive investing, grant them an unprecedented level of ownership across competing brands and critical global industries. This common ownership, coupled with their advisory roles to governments and the flow of personnel between public and private sectors, forms an intricate web of influence that extends into geopolitical arenas. It's not an overt monopoly in the traditional sense, but a quiet monopoly, an invisible hand guiding an ever larger share of the global economy, shaping our future in ways we are only beginning to understand.